So good morning, everyone. Thank you that you found the way to this amazing panel, and I'm really looking forward to all the insights our experts will share with us. So the state of yield. I mean, if we are talking about yield, the question is, what is yield actually in DeFi, or when it comes to DeFi, because it's obvious about DeFi here. So yeah, Gio or Tim, maybe, what is yield?
Yeah, okay, perfect. Well, yeah, there's obviously, I think in our industry, and Giovanni and I are pretty much sitting in the same boat because we're infrastructure providers. So yield is, probably a word we don't really we don't really mention. We call it, when it comes to staking, we call it protocol rewards, earn yield protocol rewards. It's pretty much all the same, but then yield is more, you're sitting on assets, you want to earn with your assets or something, with your, monetize the assets, and is yield what you get back, and that's kind of coming from DeFi, and then DeFi for us is more, we as sort of institutional people, DeFi is more retail right now. So yield in my world is something I don't really use as a word. We generate yield, our validators do, but it's not something when I talk to our customers, something we really sort of mention.
Yeah, like if I can add to this, it's like we're really careful to make a difference between what a DeFi yield is and what protocol staking is, because we feel it's very important for our clients, both, team, as a Figment, like the main point for us is education. And we need people to understand what are the different, risks, what are the different upsides, and what people are actually doing with their capital. Also for a regulatory reason, because it's very important for us to differentiate what are financial strategies on-chain, which is what DeFi does, borrow lending, liquidity provision, trading strategies. There's all of that with which you can generate yield, versus simply participating in proof-of-stake networks, validating those transactions, and so participating into the blockchain life. And so we've seen it also with the US government recognizing that staking is not like a financial instrument per se. And so, like, for us, it's very interesting to be here on stage today because we can discuss, I think, all the different approaches.
Thank you. So now that we have clarified what is yield in DeFi, we may introduce ourselves, because I obviously skipped that one. So I will start just to shortly introduce myself. My name is Daniela Bubak. I'm working for the German blockchain association called Bundesblock. And yeah, I'm also the ambassador of this conference, actually. I don't know if you know this, but exactly. And this is why I'm also supporting here on the panels. Maybe Tim.
Yeah, Tim Clausen. I'm with Blockdaemon. Blockdaemon is the largest global Web3 infrastructure provider. So we're running close to 300,000 nodes, and we provide node infrastructure, staking infrastructure, and what's new, and that's maybe why I'm sitting here, also DeFi infrastructure to institutions.
I'll continue. I'm Giovanni Ruggiero. I joined Figment 4 months ago to lead European kind of BD efforts. And I mean, similar to Tim's team, like we are the largest staking provider with over $16 billion of assets under staking, and so we lead kind of the infrastructure play in the proof of stake networks globally.
Yep, Levin Hosby, CTO of Fija Finance, and as opposed to these guys here who are indeed more into the staking field, we are really in the yields generating business, so we provide infrastructure to earn DeFi yields.
Cool. Marius here. I'm with Eigen Labs. Eigenlabs is the research engineering organization behind a few different things. The most known one is EigenLayer, which is, I think, the third largest DeFi protocol today with around 20 billion in TVL. But we provide a range of different services, but have built a layer of shared security using a mechanism that has been called restaking. And then we offer, on top of that, a platform or marketplace on top of which people can build services, microservices that power applications and other blockchains. And then we also have a few of our own products that we're going to market with, such as EigenDA for data availability, or EigenCompute for arbitrary off-chain computations that you can move on chain. So that's a little bit about us.
So the first question would go directly to you again, Marius. Why do you think does DeFi yield remain attractive?
I think there's a few good reasons why it remains attractive, both to institutions and to retail investors. I still today think that it democratizes access to a lot of, say, opportunities that are not otherwise accessible to, let's say, us here in the panel, for instance. There is a lot of opportunities to get exposure to, say, very attractive rates or very attractive tokenized products that, for instance, would not be available through your regular brokerage account or through your bank. So DeFi remains, say, an attractive venue for people that are a little bit more risk on and want to seek out opportunities that are otherwise not available through traditional rails. And so I think that's why, you know, it's still extremely relevant today and still has a growing appeal to a lot of people that either can't access it or just want to be slightly more risk on in terms of what they play around with financially.
Thank you for that. The next question would be for Lieven. You're the tech guy under us or under you. So are today's yield models truly sustainable compared to like 2020 to 2022?
Yeah, we definitely think so. I mean, about 5 years ago, you had lots of opportunities where you couldn't really capture the real business model behind the yields that were generated. And I think the crisis helped to clarify that a little bit. And now the opportunities that are available today, they really serve a purpose. They really serve a business. And that makes the industry much more mature and really much more sustainable. I mean, if you borrow money, you pay an interest. That's a clear business behind it. That's something that's there to stay. It's not something that's going to go away. So the inflated models where things could like blow up and explode like 5 years ago without any warning, that's kind of a little bit like moved to the side. And now you really have like real business opportunities there. And now is the time to build on that and actually offer it to users and allow them to make to earn those yields, basically.
Yeah, I agree. I mean, I think the people learned from mistakes, and the time of hopping from one hot protocol to the next big new thing is over. So you know, I think it's becoming more mature. People learn from their mistakes, and things are more sort of
Some of them
conservative and sustainable. Yeah.
Yeah, I think at the moment there are also a lot of AI experts around there, right? And 2 years ago they were like blockchain or DeFi.
That's the next bubble. Right?
Oh geez, yeah, we will see it probably.
They will learn in 5 years.
And just to add to Mario's question, so I saw just yesterday when I did some reading that the TVL for DeFi protocols is the highest now, with 150 billion locked in DeFi protocols, which is the highest in 3 years. So it tells you as well that you know, people are really back and supported by institutions as well, not just retail. It's sort of the mix between retail and institutions, probably 80% retail, 20% institution, and sort of the adoption of institutions are, you know, they're onboarding, and that will continue for the next years, and so then will also products and offers change.
Yeah, I mean, what is really interesting, also on top of what Marius said, like you need to be risk on. I think what would be very interesting in the future is as regulation comes and, you know, like these platforms become more secure, and some of them, as Tim was saying, like have billions of dollars locked there. So you have insane liquidity. You already like feel like you can move around without, you know, any problems. I feel when you're gonna look on a DeFi platform and you see you can generate 5, 6 more % on, I mean, let's say euros here, because we all talk about USD and like, but let's say euros because you don't want FX risk, versus what your bank is offering. Like at the moment, if I lock for 1 year, I get 1.5%. I need to lock my money for 1 year.
Yeah.
And this is incredible because that will democratize finance. Of course, there's a path in between where we need to be very careful and defend it from, I think, from bad actors, because those are the bad actors that led then to what happened with Terra Luna and everything that unfolded in 22. But I mean, at some points, banks will have to open their eyes and say, okay, actually, we need to give these yields back. Like, we cannot just, you know, continue making money, because their claim is that, you know, there's always something shady in crypto, something shady in DeFi, but the reality is that we're getting something back. Like, you go into a protocol, you generate a yield on DeFi, you get points, and people are excited about that because, oh, actually, I can farm the next, like, there's so many upsides versus, you know, you're in a bank, you just get 1.5%. Yeah, you're safe. The government is backing that bank, but, I mean, there's...
Yeah. And actually, when Giovanni and I are going to prospects and customers, I mean, and we sell Ethereum staking, that is a very conservative product now, right? This is a staking yield. You're around 3.5% and 4%. So it's, you know, a very, very low risk profile, a very conservative. So it's nothing crazy anymore. Yeah.
Yeah, but that's indeed how we position ourselves as well, right? I mean, also in TradFi, you have like low risk, low yield options, high risk, higher yield, and you need to have a playing field a little bit. So we're building that top end of the playing field now with the DeFi yields. So you have the basis starting point. The yield from staking will always be the bottom line, let's say, because it's the lowest risk profile possible. We provide a little bit higher risk, not super high risk, right? We have a lot of protections measures in place, but we provide a little bit higher risk profile and then also higher yields.
Yeah,
and not just 5%, but even up to 10% today is common, right? It's possible without too high risk profile. It's still a very relatively conservative risk profile considering crypto.
The exciting part is that with DeFi and programmability, you'll be able to choose your risk profile. And you move around and you essentially can just say, how much do I want to risk? And that's the beauty of it. Like, you don't really get that in traditional finance. Like, you don't really get to choose. They just already give you a bucket and, yeah, low risk, medium risk, high risk. Like, and in DeFi, you can change your risk profile real time. Like, it take you 1 year like to change your risk profile on your pension or your savings account.
Yeah, I think you're right. This is really super exciting for everyone, actually, who is somehow active in, I mean, finance. So you answered already my next question. Thank you for that. Okay, so yields aren't all sunshine. So let's dive into the risks. I mean, we just scrapped the top of it, but Lieven, which risks, so smart contracts, exploits, stablecoin DPEX, liquidity issues, are most critical today?
Yeah, for us, that's clearly the smart contract risks. It's not that those risks are necessarily higher than the other ones, but the thing is that the other ones you can tackle. DPEX, you can see them happening, you can take the liquidity out of your customers and protect them. Pools that dry out, you can see it coming along and you can take the liquidity from your customers out before it's too late. But with smart contract risks, you don't have that under control. And that's our biggest issue as a company today, that we can provide lots of automated algorithms to cover for DPEX to protect our customers from pools that dry out. But the smart contract risks, we don't really have under control. That's our biggest issue because we can't like start reading every single line of code of every single protocol and double checking that, double auditing that. That's a very hard part. There are some solutions that become available now, automated protections that claim that they can predict hacks to be possible, but they're very immature still. So that's indeed our highest risk, our key problem in terms of risks.
I mean, I'm not so deep into AI, but might they provide an answer for that or a solution for that?
Well, that's what they claim. There's also providers that claim like we do this AI layer over it and we'll predict your hack before it even happens. We haven't seen it yet. It will come, right? I mean, people know what's needed, so obviously there will be somebody coming up. Solutions get better and better, but they're very immature still.
If I can just add to your point on AI, like, I think AI will definitely help scale it, but the Black Swan event, the 0.001% event, which is actually the risk you're trying to tackle, like you probably need the human intervention. So like it will help scale. Like you can check code at like 1,000 times faster rate than you would normally, but that would still keep that very, very small smart contract risk that you have to tackle.
So maybe I have another question for Tim. Can automated 24/7 risk management really protect investors, or does it create maybe false confidence?
Yeah, I mean, the right automation tools are definitely, useful, no doubt. But I think there's also still sort of a human part to it, and that's the monitoring of these tools and see what's happening. Because obviously, things can happen so quickly, and they can happen so fast. So without you having your eyes on your tool 24/7, kind of, whatever you can do, but you still have to watch it, definitely, yeah, because it's just, smart contract hacks. I think sort of right now it's in the size still of $2 billion, so there are a lot of bad actors out there. Tools are helpful, but they're not the final solution, and they are not completely waterproof. Yeah.
Thank you. Marius, you have been so quiet. Maybe this question is something for you. So do retail investors, in your opinion, and institutions face different levels of risk when participating?
Yeah, absolutely, they do. I think if we take a step back, I think there's different ways in which you can engage with DeFi today. And I think if you think about it, let's say more holistically, there is a lot of, let's say, different rails that exist today. There is, blue chip protocols that have emerged. There are more long tail protocols that are emerging. Some have gone through, very rigorous testing. Some have, very deep liquidity. Others are perhaps a little bit more experimental, points incentivized, less scrutiny, less battle tested, higher economic risk, etc., etc. And if you say, so that's kind of that's the layer that you interact with. That's kind of the tech stack, and then on top of that, you then have, how do you engage with these protocols? Do I engage as a retail investor through my fintech bank? Do I engage with a self-custodial wallet? Do I engage through an exchange? How do I access these opportunities? That in itself poses a lot of risk. Retail investors perhaps more prone to phishing, perhaps more prone to things that we take for granted being in the industry, but navigating the crypto UI today is not always that intuitive from a retail perspective. So there's a lot of inherent risks that you just face there that you wouldn't always face as an institution if you interact through, let's say, a regulated custodian or broker, etc. And then in between, you also have a layer that's emerging with, I should say, curators, people that actually do, asset management on your behalf or automate, certain strategies for you. Some of that can help alleviate some of that risk that you, say, perhaps as a retail investor wouldn't be able to identify yourself. But on the contrary, you also put your faith in other smart contracts or other providers as well. So there's the different layers in the stack that pose different types of risk for you as a retail investor. Similarly, as an institution, I think you face some of the same risks, but typically you're also, I think, more limited to these blue chip protocols, for instance, and so perhaps less experimental. But also from an institutional perspective, you then have other risks that you probably don't face as much as a retail investor. You have, regulators breathing down your neck. You can have, and I'm a little brainwashed because I spent 5 years in crypto custody and had to deal with BaFin quite a bit. And some of these, protocols, they change quite rapidly, and suddenly you can have, concerns around, AML. You're interacting with other wallets that, come from, a sanctioned country or whatever, and so that can trigger, certain events for you that you as a retail investor perhaps are not always prone to. So there's different layers of risk, all the way from, how you interact through like systemic risk on like a protocol level to smart contract risk and others that you have to evaluate both as an institution and as a retail investor. Institutions are probably a bit better suited in terms of due diligence, I would say, and know how to underwrite, these risks much better than retail investors who will ape into, the next new thing without perhaps doing the proper due diligence. So I think, risks are ever present still, but as has already been said, the industry is maturing, and there are rails now that are, very safe also for institutions to interact with as well.
And just to add to that, I feel also that it's very important, like we say, retail, definitely has more risk, but like we also need to think that retail that is interacted with DeFi, I still would put it as, like a tech-savvy retail that, knows how to use, like a wallet. Like that, like I have a lot of friends in TradFi, experts of everything, like who absolutely struggle to open MetaMask, who've been hacked by Binance. Like there's a level of, tech savviness that you need to even just embark in this. Like, and so this has not been broken just yet. I feel a lot of, projects, a lot of fintechs are trying to break that wall, because we're talking, retail is there, but it's a very small, like it's the retail that was trading crypto in 2017. It's not the retail as we think of all the neobanks clients. That's coming, I feel, but that's not come yet. And so I don't even think we've seen everything just yet, because a lot of the less tech savvy people might have a lot more problems in interacting, and probably more likely to be hacked, more likely to click on a phishing link and everything. So we need to build the infrastructure before this wave comes to make sure that people will not look back and think of crypto as a scam and everything. Because institutions have advantages. Get better deals from DeFi protocols. Get more protections. Like they have real-time monitoring of risk. So it's very important that we prepare everything so that we will not have the regulators say, "Oh, I told you so. You should have defended them," and you haven't.
Yeah, user experience is key, and maybe a good example is Telegram with a token, right? So I think there are 1 billion Telegram users out there right now, and a really sort of big percentage already are using the wallet. Why? Because it's in the Telegram app. So easiness and quick and fast, easy onboarding is everything. Yeah.
Okay, so I agree actually that it might be a user experience question, and especially in regards to retail investors. But I have seen from the Bundesblock perspective, I've seen so many requests in our inbox actually that people have been scammed because they thought they have somehow some Bitcoin laying on their name. So it doesn't even have a connection to a blockchain. It's just a financial scam. And this is a little bit sad that this is not so known outside, because it's obvious. It's just a finance scam. It's like exactly the same as in a traditional industry. Yes.
It's the new wave of you are like I'm the cousin of the prince from Nigeria that has this many millions that wants to like give away. So like it's like Bitcoin is is a keyword, and now people look at and think, oh, actually there's a lot of people who became very rich very quickly. So someone could have actually forgot their wallet there with 1,000 Bitcoin. So like I have parents of friends who know I'm in crypto and call me up. So like I got this email, like, and thankfully like they called me up because so like they are convinced, like, is this like pure sheer luck? Like someone is contacting me to give me Bitcoin. Like when something is too good to be true, there's a reason for that.
100%. Okay. Maybe another question to Marius. What do you think? How can DeFi yield be made compliant without losing its openness? Because as far as I know, as an example, Mika does not cover DeFi. Is that correct? Or what is your experience?
Yeah, you'll always have this clash between fully open, permissionless protocols and, let's say, guarded traditional financial permissioned rails. I think we are at an inflection point right now where a lot of the bigger institutions want access to the global liquidity that exists in these permissionless protocols. The ways in which they can participate will probably evolve. I think it's very likely, and we're seeing that already, there's different types of hybrid models emerging now. You can, for instance, interact with permission pools. You can build your own permissioned chain that can have some sort of access level to public markets that still satisfies your KYC, ML requirements. So the rails themselves are improving and sophisticating to an extent that makes it easier for institutions to get access in the first place. I think regulators will have to, and now also we see also some good things happening in the US, for instance, be more progressive in terms of how they think about the industry, and eventually they need to have a more progressive stance on how we can enable interaction with this world. Yeah, I think it's very likely that we'll see changes to existing frameworks very soon. One, because the industry is expanding so fast, people want access to these markets. And two, I think we're always playing a little bit of a catch-up game with the industry, especially from a regulatory compliance perspective. And I think we're at a point now where even regulators are seeing that they need to make something that is a bit more progressive, so that both retail investors and institutions can interact and get access to yield or say on-chain activity generally.
It's of course an evolving framework indeed, and regulators will come up with new things and we're going to have to adapt to it. But even today, we, for instance, with Fija, we have a solution where we kind of shield the DeFi part in our company, and we market ourselves as a security token to the regulated institutes. So we have a couple of solutions already today available where actually regulated players can interact with a company like Fija that will then shield the DeFi part from the regulated part. So there is a couple of nice solutions available that actually work today. But obviously regulators will come up with new ideas and maybe it will become simpler and easier.
They always have new ideas.
Hopefully. But yeah, you are able to actually shield the DeFi part from the regulated part in some circumstances, which is very handy for regulated institutes.
Yeah, and we should also not only mention the regulators, but we're an American company. Our CEO was just at the White House. We were invited, one of 30 companies invited to the White House. So the current administration obviously is helping a lot, supporting our industry, putting laws in place and quickly executing. So I mean that helps the entire industry, because obviously what the US is the number one country, and the rest of the world is following. So kudos to these guys for doing things quickly and helping us.
And adding on top of what my fellow panelists have shared, I think it's to answer your question, I think we'll see a tiered kind of model, meaning, in a way, like you will have regulation across the world, but particularly for DeFi, like it's very hard to just put like like a boundary. Like the whole point of it is permissionless, is decentralized. So it's very hard to put a boundary. What will happen, I believe, in the next few years, you'll see platforms that are highly regulated, MiFID, MiCA compliant, and so with a lower level of risk or perceived risk from investors, people will go there. And let's say what we see as the crypto natives now will maybe want to stay and keep staying on the unregulated ones. And like we see today when people trade on regulated exchanges versus the offshore ones. Like I feel it's going to be hard to really just make a stark difference. It's going to be, I think, investor appetite that will drive it.
Thank you for your perspective. I think we are almost out of time. I don't know when we did start. I'm a bad moderator. Sorry for that. But I think we have a last question, maybe to all of you. By 2027, what do you think? Is DeFi yield a niche strategy or the backbone of digital finance?
I think it will become the backbone of digital finance, but 27 is maybe a bit too optimistic, especially when you talk about sort of on a global basis, because obviously you need all these regulators and governments and stuff supporting it. So I think in the long future, I think this is why we all work in this industry. We believe in it, but one step at a time. Just like everything is becoming more digital, this will be the backbone, but it will take longer.
Well, I feel it will. As Tim was saying, absolutely. 27 is really behind the corner, and we don't even know if we're gonna get DeFi and staking regulation by then. So, can't really say it's gonna be the backbone. But like, I feel, for the first time in history, we can say that finance is shifting towards DeFi and crypto and not the other way around, meaning that people will have to, start dancing at like crypto music, not the other way around. And I think it's super exciting because it will really democratize everything. Like I worked for a bank, and like banks will have to deal with that, and we'll have to realize actually, like we cannot sustain all these profits that we make because we lend everything out and we keep most for ourselves. So, like, I'm curious to see what a crypto big institution will be in a few years' time with all this M&A happening and everything, because that can really then fight the larger investment banks.
Yeah, I guess confirming here what the other two said, it's definitely not going to be a niche, but how it will be a piece of a backbone, maybe not the backbone, but a piece of the backbone. And I'm convinced indeed that TradFi institutes, they will offer it as part of their portfolio. In the end, it will be, they will still have their traditional products, but they will also be forced to offer like more modern DeFi type of products. And we'll be ready there. Maybe not in 2027, but it will come for sure.
They will have to in order to be competitive. And I think what you see now is that the, let's say, slightly more risk-on institutions, the neo-brokers, the neo-banks of this world, they are launching their own self-custodial wallets. They are launching their own yield products. It's not per se, let's say, native integrations directly with Aave. It's a click of a button and you get access to yield. And so the user experience is greatly improving for retail users. They don't need to have the, say, understanding, going to MetaMask, whatever. They can actually get access to these yields directly through interfaces that they're very familiar with. And this is something we see happening now, and I think we'll see a lot of that next year as well. Banks will soon realize that if clients can get access to this through other slightly more innovative means, they will need to catch up. I agree with Tim. I don't think we'll see the rails fundamentally change by 2027. But I think we're seeing now that people are waking up to a new reality, that they need to be competitive and they need to think about, providing access to these not only yields but financial products and primitives that are emerging on chain, because ultimately that is what their clients will demand.
Thank you very much. I will just wrap it up. So the opportunity of DeFi yields is high. The risks are still there, especially in the smart contract area, but there are already some providers who are working on solutions, right? And so what is the future outlook? As you said, in the US, there is happening a lot, especially in regards to the stablecoin theme. And I think Germany has somehow a little bit of a panic attack to try to go into the CBDC like 100%, and now it's coming in October. If this will work out or not, we will see. I'm super happy that we now have a fully regulated Euro stablecoin, Euro from AllUnity. So I think we will see, where the future is going there, especially in Europe. So thank you very much to every one of you for sharing your expertise. And please give them a warm round of applause.
Thank you.
Thank you.